So in today's episode, I want to discuss how my property portfolio looks as of June 2022. If you'd like to get in touch, I'd love to hear from you. Please send me an email at jp@australianpropertypodcast.com.au or give me a call on 0423 475 336. And please note, this show has been converted now to video, primarily delivered on YouTube. So I will still be recording the podcast as a traditional audio format, but please do check out the videos. And as always, everything discussed here is done so for entertainment purposes only. I've not taken into account your personal circumstances nor your risk profile, so you should seek professional advice before making any investment decisions. So let's get into it. So today we're going to go through a bit of detail around my current portfolio. It has been a bit of time since we have done one of these, and so I thought, look, I'll bring it all together. If you actually listen to the first episode, I cover quite a lot of the journey as to how I bought the first couple of properties, and then there was an update a couple of months back where I sort of talked about how the portfolio was currently looking and the latest property, but I thought I'd go through this in more detail today just to give, I guess, a full update and to be sort of as transparent as possible. And so note here that I'm going to be listing some estimated market values and rents. I am trying to be very transparent, but I don't want to give away the exact addresses. And some of the suburbs, there are very few properties that are of this type in terms of the townhouses. So I've disclosed the postcode region so that you can actually get a pretty good idea where it is. And I've got some pictures of the properties, but I've been able to still keep the addresses specifically hidden there. And I guess the other thing to note is the market is obviously, looking a lot shakier over the last sort of couple of months compared to where we were. And so with that, this might be one of the last opportunities potentially for some time that the portfolio will look good. So, I thought I'd sort of just be transparent about that. We're just going to show how everything looks today. So first property, coming back to that was purchased back in 2012. 217,000 was the purchase price, and basically current market is probably 340 to 350. I actually think, going back a couple of years, the even pre-COVID boom actually, that actually got up near like 400,000 value, but it sort of came down quite a bit and then has started to sort of trend up again in recent times, but this actually used to be valued quite a bit higher. I blame for that the enormous amount of construction that's taken place in the local area there, and so that's really, the extra supply has sort of impacted rents and impacted the capital growth, from this too. So this is not the exact one, but one very, very similar to it in a very similar location just down the road. So I wanted to sort of show that, and you can see market rents probably about 300 a week on that at the moment. So basically, this one, it pays pretty well in terms of the rent versus the outgoings. There's no, gym or lift or anything in the building. It's just an old walk-up style one. So the holding costs are not too bad, and it rents pretty well. Initially, I had very long-term tenants for a number of years, which was excellent. In recent times, it hasn't been quite as steady, but the market is quite strong in terms of rental demand at the moment. So hopefully this one will keep working out fine in terms of covering the cost there. The second property, so this is a 4-bedroom in the postcode region of 2770. Purchased this for 237 back in 2012 as well. Current market is very hard to determine because it's been significantly renovated, and it is a 4-bedroom place, more than 400 square meters. So it's very hard because there's not many comparable estimates to this. I'm going to say about 600 grand. It's very hard to know, but 4-bedroom, newly renovated, front and back garden. So it's, in Sydney, hard to find something of, that kind of spec anywhere that's, cheap. So that's, I guess, an estimate of the price, even though it's very hard to estimate this one. And current market rent, I think this is trending upward now, and I'd say probably at least 350 a week currently. The third one is another townhouse, same region, 2770. This one is actually a 2-bedroom. The other one was a 4. This one was purchased 2013 for 208,000. Current market, this is taken from the realestate.com.au website from memory the other day, 400k. I would probably hope for even more, but market is soft at the moment, so I'm going to run with that realestate.com.au estimate here. And market rent is probably about 290. This is on the lower side. I haven't renovated this one. It's had minor works and minor touch-ups over the years, but it needs a full reno to get to a really high level of rent. So that's just, I guess, that's the number 3. Number 4, this is a 3-bedroom townhouse. So this is a purchase in 2013 for $210,000. Current market, this one's taken from realestate.com.au again. Again, this is a hard property to value because it has not many comparables to it, basically. 3-bedroom townhouse, estimated online about $440K at the moment. Market rent, 290 plus, again, needs a reno. This one actually might even be an inferior, it is in inferior condition to the 2-bedroom. So that's, something to note there. And I guess, maybe there is scope for that one to be renovated at some point in the future. I probably have to time it right around the gentrification, because this suburb region really, it's an area where people come for value, not so much for high-end housing. So you've got to sort of cater the properties to what the demand is. So that's, I guess, the figures around that. Number 5, this is first place I bought in Queensland, so it's in an area called Redbank Plains. It's on the sort of outskirts of Ipswich. I specifically went with an area that was not in the flood path, so luckily I was able to avoid those recent floods there, and my thoughts go out to everyone who wasn't so lucky. This one is one that I've referred to a bit in the past that I regret not using a buyer's agent on. It's gone up fine, but if I had actually used a buyer's agent, I probably could have done much better. I think I was in the right, area buying in Queensland, but I probably went a bit too cheap on the sort of, spec of what I was allowing. The good thing with it, it rents pretty well, yields well, no strata, hasn't needed much maintenance. It's been quite solid as a rental performer. The growth has not been as much as I'd hoped, but look, it's going up in value, the rent's going up, there's a lot of rental demand for it. So, all things considered, it's doing fine. And then number 6, so this is the recent one that I updated on a couple of months ago. So purchased late last year, a bit over 1.4. To be, honest and 100% transparent, the valuation probably is lower already. I did buy it, at the time supposedly below market value. So we, the buyer's agent I went through, I actually paid for a private market valuation. And so pre-making the offer, I was able to get that valuation, and I was able to secure the property below that valuation. So, in theory, I sort of bought below market, one could argue. But, if I'm 100% honest with you guys, and I want to be, then the value's gone down, I would say, since I bought. Hopefully only a couple of percent, but who knows? I mean, you'd have to market it to really know, but I think the trend is down. Hopefully long term this will work out, but to be honest, my timing hasn't been great so far on this one, so we'll have to see how it plays out. Wasn't trying to time it, very specifically, but I will admit I am getting a little bit concerned around, where this sort of financial conditions are heading and the current interest rate trend as well. So that's the honest response, that it really is probably worth a little bit less already than what I paid for it. Market rent, that's probably trending upward, which is good, probably $725 at the moment, but I think that'll actually go even higher as more sort of demand comes back to some areas of Sydney. If this gets renovated, it'll probably be $900, $950 a week. There is a lot of scope for higher value rentals in this region, so that's a potential value add down the line. I guess the downside is, it is pretty capital intensive to do a full scale renovation, so that's just, I guess, a bit of optionality for the future there. One of the key things with this block was that I wanted something that had a very low strata cost, because I didn't want a situation where I had high strata cost and a modest rent, because then you don't end up with much net in the pocket. So it was important for me to get a low strata cost property in this case. Now to go through a bit of bad news. So I want to always be transparent about, the good and the bad, me going through the portfolio like this. It almost looks like I'm just sort of, showing off and look what I've got, yada, yada. So let's go through some of the downside. So, rates have jumped recently, and this is making the portfolio very negatively geared. And I do have concerns around how sustainable this is going to be in future years, if rates do rocket higher. If they sort of moderate soon, stay around these levels or go a little bit higher, then, the portfolio will be closer to self-sustaining. But if we do see what some of the forecasts are saying, multiple 50 bips rate hikes, something like that, it is going to become enormously negatively geared. So make no mistake about it, it's not free to hold this portfolio. It's requiring a lot of, contribution in terms of negative gearing. In terms of the portfolio at the moment, I've been able to fix most of it on 2-year fixed, which was done a couple months back. But the most recent purchase, which is the biggest mortgage, that one is on variable because I wasn't able to fix it. So I am completely exposed to the rate moves on that property there as well. Now to go through some other important notes. So the strategy that I've used, has typically been to revalue the property as it goes up and then basically refinance, release the equity, and then take that equity to use as a deposit for the next property. So, that strategy does work in terms of, asset accumulation. Obviously, it is a very leveraged strategy, however. But what I do want to highlight today is that there are some further implications around this strategy that don't often get discussed. I think, a lot of people sort of focus on the good and I guess the main thing is around sort of the deferred tax liabilities. So let's say you buy a property and let's say you are fortunate enough that you do make a significant capital gain and then you go and refinance the equity, let's say up to 80% again, which is a pretty typical sort of investor strategy. The challenge with this that no one talks about much is that, you are a little bit trapped in the property then because, for example, if you then, so you've refinanced up to 80%, you've taken the equity out, you've gone and used that as a deposit or you've gone and invested that in shares or, wherever you've invested that. And so, let's say you've been diligently not spending it on lifestyle, you've been diligently refinancing and just investing your money, right? Now, as the value goes up, the amount of potential capital gains tax that you may be liable for potentially will increase as well. And so you have this situation where if the property goes up a lot in value, you've got, a large capital gains tax bill for the difference between, your future sale price and your purchase price, right? And you might get a 50% discount if you've held over 12 months and that kind of thing. But the point I'm getting to is if you've refinanced multiple times and taken the equity out multiple times, you're likely going to have a highly leveraged mortgage against the value. And then if you actually then go and sell, once you look at your capital gains tax bill, pay that, there's very little actual money left over. So you're sort of almost trapped in the property in terms of that it barely makes it worth selling anymore. All your equity, you've already used it to go and re-leverage into another property. So on face value, when investors present potentially a situation like this one today to you, you might look at it and say, wow, the asset position value is quite reasonable and there's, some wealth that's been accumulated there. But the practical reality is if you were to try and liquidate this portfolio tomorrow, then the net amount of equity left over wouldn't be that significant. You're like putting yourself in a position where you're very much leveraging up for future capital growth. And so I just want to be transparent that that's the reality of the situation here. And a lot of these investors you see that do have these big property portfolios, it's often not a case where, they've got millions and millions of equity that can just be pulled at any time. It's literally a situation where they may be very leveraged. So I'm not an accountant and you need to seek your own professional advice on that topic, but that is just something I wanted to be transparent with you guys on today as well. And so basically, I guess just wanted to sort of finish this one today with a bit of quick request, I guess, if I may. I am transitioning the show mainly to videos, so if you'd subscribe to the YouTube channel, that would mean a lot to me. I'm also presenting this across most platforms, so if you just search up my name, you'll generally find the content across most platforms now. But yeah, if you'd please subscribe and like the videos, that would mean a lot to me. And please note, as always, everything discussed here is done so for entertainment purposes only. I've not taken into account your personal circumstances nor your risk profile, so you should seek professional advice before making any investment decisions. I really appreciate you tuning in as always. Thank you.